Hello, everybody. My name is Rolanda Watson, and if you don't know me, I am a tax strategist and enroll agent. I have been in the tax industry for over 25 years, and I love helping individual and business owners minimize their taxes. I do three things essentially in the tax world. I file your current and back taxes. I fix your tax debt. Yes, I talk to the IRS on your behalf, negotiate for you, work out any settlements, and get penalties abated for you. I also find legal and customary tax savings for you. So today I want to take a look at the big beautiful bill, as our current administration calls it, but my focus will be on business owners. I've already done a video for individuals, but I want us to look at business owners. That would be your sole prop, your your LLCs, limit liability companies, single member and multi-member or partnerships, and also our elected S corps, and then of course our C corps. There are just a few things that we have in this current bill that will be beneficial for you. Now, of course, I can't go over everything because the thing about business owners, every business owner is different. What their goals are different, what they want to go for is different. So this will be a broad overview of what some of the things are in this bill that you may want to look into more for your business. The first thing that we'll be looking at is the bonus depreciation. We again have the 100% bonus depreciation for business property. The good thing about this is I've often gotten asked the question, can I take 100% of my bonus depreciation as well as my regular depreciation? Yes, you can. There are certain situations and things that we have to do to pay attention to the basis of that, but yes, you can. That is a huge benefit for business owners because think of it, you get to take 100% of the asset that you purchased, write it off. And you might say, well, really, what is a depreciation and how does it benefit me? Taking 100% of a depreciation, first, a depreciation allows you to take the deduction for an asset over a period of time. If you take a bonus depreciation, you get to accelerate that deduction. So instead of taking it over 5 years, over 15 years, 39 and a half years, you get to take 100% of the depreciation expense for that asset or that property in one bang. So this is a bonus depreciation plus, depending on your basis, you can still get the regular depreciation for that property. So that is a huge, big deal. R&D expenditures. This is good for our tech companies, our companies that are new start and developing. The research and development, you will again get to expense your research and development. That is a big thing. So that is continuing on as a full deduction for you. Let's look at our section 179. What is the section 179? Section 179 is in the depreciation world as well. However, this says if you have an asset that is starting this year up to $2.5 million, you get to depreciate that all at one time. But here's something I like to remind my clients. When we do a section 179, that means we take the total value of it all at one time, and we do not intend on selling it. That's fine. But if we sell that asset, we have to recapture or pay back the value of that asset or what it was when we depreciated it. So again, the depreciation for the 179 used to be, it was like 2.1 or 2.2 million. Now it's 2.5 and it phases out at 4 million. So that's a good thing on an increase for that when you want to make a big purchase. QBI is something that came out in the Tax Cuts and Jobs Act 2018 to 2025. That is now permanent, and that's going to continue to be with us. Just a refresher on what QBI is. It is a qualified business income deduction. It is an above the line deduction. And so essentially what that says, let's say that you're a disregarded entity, a um, a Schedule C filer, solopreneur, or elected S corp, whatever entity you are. After all of your expenses, your net profit is $100,000. So QBI says that you get to write off 20% of that. That's the 20,000. That deduction was up to be expired here in 2025. It is now set and it is a permanent deduction that we'll be able to take. So that's a good thing for our business owners, whichever way you are, if you're a disregarded entity as a Schedule C, or if you are a pass-through elect S corp, or if you are if you're a partnership, not if you're a C corp. But these get to pass through onto that 1040, giving you that 20% off of your net profit. Another thing that I want to talk about is what's been called the opportunity zones. That's going to continue here for us. This is a big one for our investments. Our real estate investments are those that are investors, whether it's mutual funds, stocks, what have you. The opportunity zones, as I said, it's going to continue. And essentially what that says is if you have capital gains, you can take those capital gains invested in a particular area. Typically, it's a low income area, and your state will have ideas of what those areas and zip codes are. If you invested in that area, leave that investment there for 10 years, then you can exclude the tax on that investment, meaning real estate property. Let's just say you invest 100,000, you have 100,000 in your capital gains. That could be from stock, that could be from a pass-through with your S corp, your shareholders passing through, or partnership with shareholders passing through into the 1040 tax return that shows up on the 1040. Instead of paying that capital gains, you take that capital gains invested in what's called an opportunity zone or an area. You let that investment stay there. If it stays there for 5 years, then you can get a 30% step up in basis. But if it stays there for 10 years, then you could be excluded on the tax. One interesting thing that I'll bring out is that there was no discussion. I didn't find anything on entertainment. If you remember with the Tax Cuts and Jobs Act, the bill from 2018 to 2025, they took away our deductions for meals and entertainment. We could deduct a certain amount for meals that went to about 50% on the individual, and certain meals went up to 100%, but we could not deduct the entertainment. I didn't really see anything in this new bill about continuing the entertainment or cutting the entertainment out altogether. So that pretty much remains to be seen on the entertainment ends. And many times business deals are made in a place of entertainment, at games, on the golf course. Again, business deals are made at the place of entertainment. The last thing that I will share is that there has been a termination of our green energy credits. So the credits for clean vehicles, fuel credits, the home improvement credits, there's been a termination on those credits. And I know a lot of times our business owners would use those credits for themselves and to talk to their clients about getting some of the equipments that are used for those credits for your HVAC or purchasing a clean vehicle. Those credits have been terminated. So you want to make sure that you are aware of that. Again, as I stated before, this is an overview of the credits, and you want to make sure that you talk to myself, or if you have your own financial planner, not financial planner, tax planner, to see how you can better use these new credits that we have. This is the best time to use them or to explore how your business can benefit from them. We don't want to wait until December to start strategizing to use these credits for our business. Again, my name is Rolanda Watson, and it is my goal to make taxes stress-free for you. Have a great day.